Hi, this is Ankur. In this video, we'll discuss about how mutual funds can be used to structure your entire portfolio. So mutual funds are in three categories that are available: equity, debt, and gold. Here is a moderate profile, which is 50% into debt, and in equity we have 45% and 5% in gold. You can allocate 10% in gold and allocate 45% in debt, but point remains, overall this is the allocation for a moderate risk profile. Within that, what kind of allocation you should do for a moderate portfolio? Well, a moderate portfolio should have a combination of debt and equity. Gold we will not discuss because gold is a commodity. You can pick up any mutual fund investing in gold that has the lowest expense ratio. In debt, we invest 40% in liquid, 30% in short-term debt, arbitrage 20%, and credit risk 10%. You may have observed that I have not allocated anything on the medium term or long term, because usually that category would be more bracketed towards retired people or people planning for retirement in a conservative way, gets very specific to an individual kind of allocation. And it is a very volatile segment also. With the interest rate increase, there would be decline in the prices. So you should be looking at debt only from a cash preservation point of view and earning a return little better than the inflation or matching the inflation on a pre-tax basis. So I have this combination for moderate risk profile. A liquid fund is the fund that invests in treasury bills maturing in less than 3 months. Short-term debt would have 1 to 3 years horizon, the maturity. Arbitrage fund will provide you a risk-free rate in the economy, which is between 5.5% in current time. Credit risk in today's context may be useful because cleanup of credit market has happened due to the pandemic period, and usually clean investments are available at this point in time, and the risk advantage could be there, earning between 7.5% in the current market. Obviously, if it is aggressive, the debt allocation will reduce to further 25% overall, and instead of liquid, probably that bucket will go more on the short-term side and distributed along arbitrage and credit risk. If you are conservative, then you do not invest in credit risk. You invest more in liquid short-term debt fund. Even you will drop arbitrage fund or reduce it to say 5-7%. These are tailor-made solutions and not a generic solution for all. So it all depends on your goals, your requirements, and accordingly portfolios are structured. They are not structured in isolation. So your personal goals have to fit in well. There is no standard allocation. Now we move to the equity side. For a moderate profile, a large cap could be a 30% allocation. These are large companies, blue chip companies. Mid cap could be 30%, small cap is 20%, and multi cap is 20%. In case a person is conservative, allocation will be more on large cap and less on small cap. Similarly, if someone is aggressive, the allocation from large and mid may shift to small cap. Again, how much percentage shifts varies from investor to investor, and there is no standard allocation. And interestingly, there should not be any standard allocation. It should be always customized and personalized. There is no standard solution in investment markets. Within the investments, you can have a standard allocation, for example, investing in a good large cap mutual fund, but how much to invest in large cap mutual fund is always specific to your requirement. This is the job of an advisor to figure out how much allocation is the appropriate allocation. And there is no standard recommendation or solution for individual investors. In this video, I wanted to give a perspective how you can use mutual funds in different forms and combine them. So in total, you can see that your overall mutual funds should not exceed beyond 8 to 10, and this includes gold fund and this includes debt fund. If we were to just talk about equity, they will not exceed more than 5. If you're exceeding more than 5, then obviously there is an overlap, and your benefit of diversification is actually translating to more over diversified allocation than a diversified allocation. So you can always combine your mutual funds without going even a step further in terms of how to structure your portfolios that will continue to grow and give you a decent return over a period of time. And it is not just about return, it is also about meeting your personal financial objectives. I think to start with, people can always start with a combination of mutual funds and let it grow. And these are always specific to your individual needs and requirements. If people try to tell you that there is a standard solution, there is no standard solution. In case you do not want to take external help, then you can read and understand more, probably watch similar videos as this to really figure out what should be the right allocation for your personal needs. I hope you like the video. Thank you for watching.